Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. With me for our Beyond the News interview is Esmée de Neijs, Course Research Assistant at IBFD in Amsterdam. On today's show, after reducing tax rates to accommodate COVID, Kenya plans to raise them again. But is it too soon? Come January, Mexico will require digital service providers to collect withholding taxes on top of VAT, imposing a harsh penalty on sellers that fail to pay. And Russia meets its match. These and more, including Esmée de Neijs' interview with Bert Zeldentorp, Head of Unit Company Taxation Initiatives at the Directorate General Taxation and Customs Union of the European Commission, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. From the beginning of the COVID-19 pandemic through today, governments around the world have made accommodations to help their citizens and businesses cope with the challenges of complying with the tax laws in a time of economic and societal paralysis. Thus, they have extended and re-extended deadlines for filing and paying taxes, as U.S. state governments most recently did in California, Colorado, Minnesota, and South Carolina. They have delayed the effective date of new disclosure requirements, as Portugal, following its European neighbors, just did with DAX 6. They have offered COVID relief programs and adopted new ways of dealing with tax authorities digitally instead of in person, most recently in such diverse places as Rhode Island and Pakistan. And perhaps most importantly, they have reduced their tax rates. But no country has dared roll back these relief measures while the pandemic rages, until now. Kenya has just proposed to raise virtually all tax rates to pre-pandemic levels beginning on January 1st, 2021. This raises the question of whether that country anticipates a return to normal before the rest of the world, or it simply needs the money. Fortunately for low-income Kenyans, the country will still retain 100% tax relief for low-income taxpayers. As we recently reported, Russia has been playing hardball with its treaty partners as it seeks to generate badly needed revenue. And it has largely succeeded. That country recently negotiated new tax treaties with Malta, Cyprus, and Luxembourg that imposed a 15% withholding requirement on income generated from inbound investments from those countries. But the Russian bear may have met its match in The Hague, announcing last week that it was unable to negotiate a new tax treaty with the Netherlands to replace the 1996 treaty. The breakup came after Moscow insisted that the new treaty require 15% withholding on Dutch investment income. Perhaps orange really is the new red. Many countries in Latin America require remote digital service providers to collect and pay VAT on services provided to their residents. But Mexico is taking taxation of remote sellers to a new level. Starting on the first of the year, Mexico will require remote sellers to collect and pay withholding taxes on their activities in Mexico. Rates start at 1% on sales of goods and services, rising to 2.1% for ride-hailing and delivery services, and 4% for accommodations. And Mexico has found a unique way to force service providers outside the country to comply. It will simply block their ability to connect to customers in Mexico through the internet. Clever. Turning to other news, speaking of digital taxes, countries are just beginning to consider the implications to their own taxpayers of digital service taxes imposed by other countries. Are they deductible, creditable, neither? To that end, Singapore has just clarified that its taxpayers may not deduct income taxes paid to other countries, but they may deduct digital service taxes such as India's equalization levy and the UK's digital services tax. The EU continues to flex its muscles to bring member states' tax regimes in line with state aid and other European rules. To that end, the European Commission advised Italy to abolish its corporate tax exemption for ports, and told Portugal that its free zone for Madeira is incompatible with state aid rules. The EU has also directed Greece to bring certain of its inheritance tax rules into compliance with EU law. The UK has opened a public consultation on draft rules that would expand the scope of its taxing authority over gains realized by non-UK residents through investments in funds that hold property in the UK. Under the proposal, the UK would be able to levy taxes on capital gains realized by non-UK residents from UK property-rich collective investment vehicles. The OECD recently released its annual study on consumption tax trends. Weighing in at a hefty 218 pages, the study includes a wealth of valuable data. What is not at all remarkable is its conclusion that because of the pandemic, OECD countries are likely to see a significant drop in revenue from consumption taxes in 2020. We can only hope that the 2021 study reflects the opposite. And finally, around the world, countries are finding creative ways to stimulate their economies during the pandemic. But Zimbabwe may have reached a new high for creativity with its new export levy on cannabis-derived products. Now we go beyond the news for Esmée de Neijs' interview with Bert Zeldentorp at the European Commission. Esmée.
Thank you, Stuart, for your very informative news report. Hello, everyone. My name is Esmée de Neijs, and I'm a course research assistant here at IBFD. And with me here today is Bert Zuijdendorp, Head of Unit Company Taxation Initiatives at the Directorate General Taxation and Customs Union at the European Commission. Welcome, Bert.
Thank you very much, Esmée. It's a pleasure to be with you today, even at a distance, but yes.
Well, thank you very much for joining us. Bert, you're leading the Commission's work on EU directives and policy initiatives in the field of corporate taxation, including the work done by the Code of Conduct Group. And with that, I was wondering, when the first list of 17 non-cooperative tax jurisdictions was published in 2017, it grabbed quite the attention, and some of which were not all that positive. Critics even claimed that the EU didn't practice what it preached by not including the EU member states in its reviewing process, and perhaps by not always showing enough transparency. Was this the kind of response that you expected?
Thank you. Well, frankly, I think we were not surprised that this initiative would attract a lot of attention, and that people might have quite outspoken views on this issue. Also fueled, I think, by sort of the scandals that we've seen, the leaks that were revealed by a number of investigative journalists. So we knew there was a lot of attention for this subject, and so we were not that surprised. But perhaps I should explain briefly why we sort of did it the way we did it. And I think it's important to understand the background. And the background to this is, of course, that within the EU, we've been leading the way when it comes to implementing tax good governance standards for the past decade or so. So in terms of transparency, we were the first to introduce as a block automatic exchange of financial account information, the common reporting standard. We were the first to introduce automatic exchange of cross-border tax rulings, the first to introduce country-by-country reporting between tax administrations as a block, disclosure, mandatory disclosure of aggressive tax planning schemes, and well, still to come, but thanks to the German presidency, we will soon also be introducing automatic exchange of information on digital platforms. So we've been leading the way when it comes to transparency. We've also been very active in the area of introducing anti-abuse measures, anti-base erosion and profit shifting measures through the anti-tax avoidance directives 1 and 2, so which provide for common rules on interest limitation, CFC rules, rules to tackle hybrid mismatches. And then, of course, we've had the work of the Code of Conduct, which has been looking at member states' harmful preferential regimes for 2 decades. So just to say, this is an area in which we've already done quite a bit at EU level in the past decade. And I think it's against that background that we felt that we should also address the external dimension of our work and ensure that the tax good governance standards which are applied within the EU are also applied beyond the borders of the EU. And this is, I think the EU list is the most visible aspect of that policy. So, but in a nutshell, we were trying to get third countries to apply the same standards that member states already apply in a legally binding way through directives, etc.
Well, thank you for that elaborate explanation. I think it really shines a better light on showing that it wasn't the first step, but actually, we've done our part and now we move forward and showing it to the rest of the world. Could you then perhaps tell us what the most common tax technical issues were so far that you run into with third countries, and perhaps whether the global change of perspective on tax good governance is reflecting in these ongoing discussions?
Yeah, so I think, to be honest, I mean, this was quite a new process, a new exercise for us, sort of engaging with more than 90 jurisdictions around the world. I think for us, this was also a learning experience. So it started by having to examine the tax regimes of more than 90 countries. So it was a lot of fact-finding to begin with. But then we entered into a dialogue with these jurisdictions, which was both enriching and very sort of intensive in terms of the amount of work involved. I think through this dialogue, we also discovered a lot of new things about third countries, but also about the tax systems they applied. And I think this also influenced the work that we did. And so there were work streams that we had perhaps not envisaged when we started this work, but which sort of developed as we went along. For example, I think the work on zero tax jurisdictions is something that was quite new to us, having sort of not dealt with sort of zero tax jurisdictions within the EU. So this was a new development where we needed to find new ways of tackling the issue, which then sort of later also influenced the international discussions on the same topic. So this is something that we started and that was then picked up by the OECD, by the inclusive framework. So I think this is just an example of where we sort of face challenges because our sort of tried and tested methods that we applied within the EU sort of did not fit the realities of what we found in third countries.
Yeah, well, that also brings us a bit to the other perspective, and that's of course that the EU list of non-corporate tax jurisdictions is actually not the only blacklist in town. The OECD peer reviews harmful tax regimes based on BEPS Action 5 minimum standard, and there are quite some countries within the EU and outside the EU having their own reviewing process, all leading to different blacklists with different consequences. And would you actually think it would be a good idea to collaborate in the future, for instance, with third countries or with the OECD, to perhaps align the standards for good tax governance globally?
Yes, no, you raise a very valid point that we're not the only show in town when it comes to this work. Fortunately, I should say, because I think it is important that we all sort of join forces to promote these standards both in the EU and globally. So I think we very much welcome the fact that this is not just an EU preoccupation, but it's also sort of a wider international issue. I think, in fact, we already cooperate quite closely with the international standard setters, such as the Global Forum on Tax Transparency and the Inclusive Framework on Base Erosion and Profit Shifting. So both at the technical level, the level of secretariats, but also in terms of the criteria that we've developed and that we promote internationally. And in fact, we rely for a large part of our work on the work done by these international bodies, their assessments, for example, on transparency. But we also closely cooperate when it comes to preferential regimes, where sort of the work of the Code of Conduct Group at the EU level is closely aligned with the work of the Forum on Harmful Tax Practices at the OECD, at the Inclusive Framework. So I think this is already an ongoing process and one I think we need to continue. and where I think we can sort of mutually benefit of the work that we do. But what we've seen as a result of the work that we've done in the context of the EU is in fact that third countries that we joined these international bodies as a result of our engagement with them. So I think we actually also help push the international progress on these issues through our work on the EU list, which I think was a very positive side effect of the work that we do.
Yeah, we do indeed see a little bit of a domino effect that countries take more and more defensive measures on multiple layers in taxation. Then looking further forward and also towards the EU tax package on fair and simple taxation published last July, it was announced to reform the code of conduct, and one of the desired changes is, for instance, to align the criteria with the changing tax climate. How would the OECD's two pillars on digitalization, or the challenges arising from digitalization, fit into this picture?
Yes, so indeed we presented an action plan before the summer with many recommendations, some of which relate to tax good governance and both to the code of conduct and the EU listing process. So we're making suggestions to review both. I think when it comes to international developments, obviously the ongoing work on pillars 1 and 2 on providing new rules of profit allocation and minimum effective taxation are extremely relevant to our work. I mean, they have the potential to completely change the international tax landscape, and obviously that will also have an impact on the work that we do in the context of the code of conduct. It is clear that, and not just the code of conduct, by the way, I think it will also have an impact on the forum on harmful tax practices. It is clear that particularly Pillar 2 is a game changer. If we really move to a global system of minimum effective taxation, that will have an impact on the work that we've been doing on preferential regimes, both within the EU and in relation to third countries at international level. So I think we're very happy to see that under the German presidency, the discussions on the review of the mandate of the code of conduct have started. We think that these discussions are long overdue. I mean, the code of conduct dates from 1997, and we think that the world has changed quite radically in the past 2 decades, and that should be reflected in the mandate of the group. So we're glad to see that work has started and that it will continue under the coming presidencies, the Portuguese presidency and beyond. And we're also welcome the fact that the EU finance ministers quite recently have sort of said that as part of this work, we should also take into account international developments, and obviously the work on Pillar 1 and Pillar 2, and hopefully leading to a global consensus in due course, are extremely relevant international developments, which should also have a bearing on, we believe, on the code, the work of the Code of Conduct Group.
Well, let's see what the future in the end will hold for us, and hopefully we'll see that in indeed due time. Well, that's all that we have time for today. With me here today was Bert Zuijdendorp, Head of Unit at the European Commission. Bert, many thanks for being here today and sharing your insights on the EU Code of Conduct and the list of non-corporate tax jurisdictions.
Thank you very much, Esmée, and my best wishes to you and the colleagues for the festive season.
Thank you very much. Well, that wraps up this year's last episode of IBFD Tax Takes News and Views, the week's tax news in a nutshell. We will gladly welcome you back in the second week of January after our Christmas break. And from Stuart and myself, thank you for watching and wishing you all happy holidays. Here's hoping your year was not too taxing.